All right, for Chapter 12, we're going to be looking at how we go about accounting for cash flow. And obviously this is extremely important because if you don't have the cash to handle your business, then your business isn't going to stay afloat very long. So the purpose of the statement of cash flows is to report any cash inflow, cash receipts, and any cash outflows during a particular period of time. So it's another financial statement, just like our income statement and our balance sheet and our statement of retained earnings. This is a fourth statement that, generally speaking, you'll find in a collection of financial statements so that you can see how this particular company makes use of their cash. So as they list here that there's three basic questions that can be answered. How does the company obtain their cash? Where does it spend its cash? And how do you go about explaining the change that takes place in the cash from the beginning of the period until the end of the period? I'll let you read this part here yourself about why this is important, because when people who don't do accounting, they don't seem to understand that just because a company can show a net income for a particular period of time does not necessarily mean that they have adequate cash on hand. So just because a company is on paper making money does not necessarily mean that they have cash in the bank. And this statement that you're going to learn how to do will show you how to distinguish between net income and actual cash flow. Now, when we talk about cash flow, we're not just talking about the actual dollars that you might have in a bank account. There's also something called cash equivalents. And cash equivalents are anything that can be readily converted to cash and is also sufficiently close to its maturity date so its market value is unaffected by interest rate changes. So this would be things like stocks and bonds. You don't call those cash equivalents if they are locked up and you're not able to have access to them and that their maturity date is not 90 days or less. So it's a cash equivalent, generally speaking, if the maturity date on those securities is 90 days or less. That's the key when you're talking about a cash equivalent. Now, when we talk about cash flows, and this is going to be confusing. Until you've done it a few times, it really doesn't seem to make a whole lot of sense. But it's kind of, again, one of those things we've talked about as the semester's gone on, about sometimes you just have to memorize it, and then the more you do it, the more you'll realize why you're doing it that way. So what we're looking for is cash that comes in or goes out through three different types of activities. We divide the cash flows into three different types of activities. The first of those is our operating activities. And this is the easiest one to understand. These are activities that determine your actual net income. So it's the money that comes in from your sales, mainly, and the money that goes out to cover all of your operating expenses. So this gives you some examples here. The production and purchase of merchandise, the sale of goods and services, and the expenditures like utilities and phones and things like that to administer the business. Now, there are some things that you might have in income that aren't considered operating activities, but we'll get more into that a little bit later. So please read this information carefully and try to, in your own mind, distinguish between an operating activity and then the next one is an investing activity. Investing activities generally include those transactions and events that affect long-term assets. So this is mainly the purchase and sale of long-term assets. So this is important. Keep this in mind. When you're talking about an investing activity, you're talking usually about something that is going to go on the long-term asset section of the balance sheet. So it also can include the purchase and sale of short-term investments in the securities of other entities, and if you lend or collect money for notes receivable. Now down here it gives you some examples of things that would be investing activities. Selling investments in securities could bring in money. Selling notes that you have can bring in money. Collecting principal on loans that you've made. And then selling long-term productive assets. So if you sold a building or you sold a piece of land, that would bring in money. And then cash outflows, if you are loaning somebody else money, I mean, eventually you're going to get that money back, hopefully, but when you first loan it out, it's going to be a cash outflow. But also, if you're purchasing a long-term productive asset or purchasing investments in securities, that's going to be an outflow. So these are the kinds of things that would be considered investing activities. Excuse me. And then financing activities. It includes those transactions and events that affect long-term liabilities and equity. So the difference between these two mainly is that this affects long-term assets. Financing activities affect long-term liabilities and equity. So an example would be if you're obtaining cash by issuing notes and then you have to repay that amount that's borrowed. Or if you're getting cash from the owners or distributing cash in dividends to the owners. If these are considered financing activities, not investing activities. And this is where it gets confusing, because until you've done this, again, several times, it may be confusing as to which of these categories something falls into. Usually the operating expenses is pretty easy, or the operating activities is pretty easy. But keep in mind that this one affects long-term assets, whereas this one affects long-term liabilities and equity. And then again, they give you a little chart here of some examples. Now, there can also be non-cash investing and financing, because it doesn't actually affect, these activities don't actually affect cash inflow or cash outflow. So if you're doing something, and we'll talk a little bit about this here in a second, if you're doing something that is considered an investing or financing activity, but yet it's not actually costing you cash or not bringing in cash, then what you do is you add a statement to your financial statements just to disclose what that activity was. Because let's say in this example, if you purchase a long-term asset, but you do it by issuing a long-term note payable, so you get a loan to do it, there's no cash involved here. So that doesn't go on the cash flow statement, at least not in the sense of it showing cash in or out. But you disclose it by just explaining what you did and how it doesn't affect the cash inflow or outflow. And then they give you another example here. They also give you a list of some transactions that are commonly considered to be non-cash investing or financing activities. So just keep in mind there can be activities that take place that involve investing or financing, but they don't involve cash, so they're not actually on the statement of cash flow other than as a disclosure. All right, so let's look at what a statement of cash flows actually looks like. Okay, accounting standards require companies to include a statement of cash flows in a complete set of financial statements. So this is something that is now required by accounting standards when you have a full set of financial statements. So the first thing is that you put all cash flows from operating activities at the top, then all cash flows from investing, and then all cash flows from financing. So it can be money coming in or going out. This could be negative. It doesn't have to be positive necessarily, because if more goes out than comes in, it's going to be negative. So then it shows you your net increase in cash. If you add these three things together, it's going to either give you a net increase or a net decrease in cash since the last statement. So this is covering a particular period of time. So then you put down, well, what was my cash balance at the prior statement? And if you add the net increase or decrease to what you had at the prior statement, you should get the figure that you currently have. So this is the basic format of a cash flow statement. Now, let's talk about how you actually go about doing that statement. Okay, this explains that it involves 5 different steps. The first is that you have to compute the net increase or decrease in cash for that particular period, which is what we just did up here. The net increase or decrease in cash would be right here. Then you compute your net cash specifically from operating activities, then investing activities, then financing activities, and then that should match what you've already calculated over here. So you can reconcile it, so to speak, and make sure that you've done it correctly. Okay, so computing the net increase or net decrease in cash is a simple but crucial computation. It equals the current period's cash balance minus the prior period's. So what you're going to do is look at your cash account, so to speak, and say, okay, my cash account today, at period end, is $10,000. At the end of the last period, let's say it was $5,000. So the difference between those two is $5,000. So when you go through each of these steps, you should get the same thing here. You should be able to reconcile to that same number. Now, there's 2 alternative approaches to preparing the statement. The first is just by analyzing the cash account itself. The second method for doing it is by analyzing the non-cash accounts. Analyzing the cash account is the most direct way of doing it because every cash transaction is going to be in that cash account, whether it's money coming in or money going out. So it's a natural place to look for that information. So if you look at this example here in Exhibit 12.6, you see the individual cash receipts here on the debit side, obviously, and then the outflow here on this side. Now what they've done is they have summarized all the receipts, all the cash receipts from customers into one figure. Otherwise, you'd have thousands and thousands of entries here. And then all receipts from any asset sales and all receipts from issuing stock. And then over here they have the same kinds of lump sums. All your payments for merchandise during the period are listed in one number. All your payments for salaries and operating expenses is in one number. Now, as I said before, these would actually represent several different transactions. It's not just, you probably didn't just make one payment for merchandise during the course of the period. So the problem can be when you're trying to analyze the cash account, even though it may be the most direct way of doing this, if you have thousands of receipts and thousands of payments, it can be tedious to try to calculate things this way. Now, obviously, in this situation, we probably have a computerized a program that has lumped everything from customers into one number. So, if you're doing it that way and you're using a computer, then probably these numbers are not that hard to come by. So preparing the statement of cash flow from here, this would be the information that you would have. So to actually create the statement of cash flow, you would come down to here, and you're going to list the activities here under the correct category. So all the cash flow from operating activities. So cash received from customers is an operating activity. The cash paid for the merchandise that you sold to the customers is an operating activity. Cash paid for wages and other operating expense, operating activity. And then interest and taxes are considered operating activities. So then you get your net cash provided by operating activities of $20,000. Then investing activities. Sale of plant assets is considered an investing activity. Cash paid for plant assets, an investing activity. So in this case, the net cash provided by the investing activities is $2,000. And then the following things are financing activities: issuing stock, retiring notes, paying dividends. So here you have a negative amount, net cash used in financing activities. If you add these three numbers together, you get the net increase in cash of $5,000. The cash at the beginning of this period was $12,000. So if you add these two together, you should get the cash balance at the end of the period of $17,000. And if you look back up to your cash account, if you were to add all of this together and subtract all of this, you get $17,000. So you've just proven your cash account. This is correct because these two numbers match. So that's the way that you can do a statement of cash flows directly from the cash account. But again, there's limitations to doing it this way. And as I said before, most companies have many individual cash receipts and payments, making it difficult to review them all. And even though accounting software can minimize this burden, it's still a task requiring professional judgment as to what type of activity each of these transactions, where it should fall. And the cash account itself doesn't always have an adequate description, so it might make it difficult for us to know which activity to put it into. So the second approach to preparing this statement of cash flow is to analyze non-cash accounts. Now, at first that may seem like it doesn't make sense. You're trying to analyze cash flow without looking at the cash. But the fact of the matter is that every cash transaction involves another account. Because remember, in double entry accounting, if you have an entry to cash, whether a debit or a credit, you have to have the opposite entry to some other account. So whenever you record something to cash, you also record a credit or debit in a non-cash account. Many of these are balance sheet accounts. Like if you bought land for cash, then of course you would be debiting land and crediting cash. The others are going to be revenue and expense accounts, and those accounts get closed to equity. Remember, we close all the revenue and expense accounts to income summary, and then income summary gets closed to retained earnings. So in the long run, all cash transactions will eventually affect non-cash balance sheet accounts. So we can analyze cash flow by analyzing changes in the non-cash balance sheet accounts. And if you look at this illustration here, this exhibit, it uses the accounting equation to show the relationship between the cash account and the non-cash balance sheet accounts. If you look at the top, the basic accounting equation is assets equal liabilities plus equity. Assets, if you take cash out of that, then you have cash plus all other non-cash assets equals liabilities plus equity. So what you can do, just, as you understand basic algebra, if you then take the non-cash assets and subtract it over here, you end up with cash equals, oops, sorry. Oh dear. I apologize. Let me get back to the book. Okay, sorry about that. So if you then move this, subtract non-cash assets from both sides of the equation, you end up with cash equals liabilities plus equity minus all non-cash assets. So then you would have the changes in the cash account equal the changes in the non-cash accounts. So think about that. Look at the diagram and look at the explanation here. But that's why you can do your statement of cash flows by analyzing the non-cash balance sheet accounts. So where do we get the information that we need to be able to do this? Well, definitely from our balance sheets, and what they mean by comparative is one statement to the next. So you have last period end and this period end that you're comparing. Then the current income statement for this particular period, and then there will be some other additional information that you might have to have. But the basic things are the balance sheet from last period and this period, and then the current income statement. So basically, even though the cash account is a very direct way to do this, it's usually simpler because of a large number of transactions to do the statement of cash flows from the non-cash accounts. And so the book is going to go on to explain how to do that. So let's go up to the next section. Should have made this bigger. Sorry about that. And we're going to talk about we're going to talk about cash flows from operating activities, but let's talk about indirect and direct methods that are used to do that. So cash flows by operating activities are reported in one of two ways, direct or indirect. And this is only for cash flows from operating activities, not the other two types of activities. The direct method lists each major item of operating cash receipts and each major item of operating cash payments. Then you take the cash payments and subtract them from the cash receipts to get your net cash provided or used by operating activities. The indirect method starts with net income and then adjust it for activities necessary to obtain the net cash provided or used by operating activities. So it doesn't report individual items coming in or out. It starts with the net income figure. Now, the amount you're going to end up with, regardless of which method you use, is going to be the same. The net cash amount provided by operating activities should be identical under the two methods. It's just a different way of doing it. Financial Accounting Standards Board recommends the direct method, but the direct method is generally more tedious to do because you're having to list each individual thing. And so it's not required, even though it's recommended. So most companies actually use the indirect method. All right, so they give you an example here of a company called Genesis, and they show you the comparative balance sheets for December 31st, 2012, and then 2013. And then they also have the 2013 income statement. Then they're going to tell you the information to explain that $5,000 increase in cash for 2013. So the $5,000 is computed as cash of $17,000 at the end of 2013 minus the cash of $12,000 that was available at the end of 2012. So the increase in cash for this year should be $5,000 because last year's statement ended with 12, this year's statement ends with 17, so there's a difference of 5,000. This is the information that we have regarding what happened in 2013. Now, you can read the information that they have here. These are the different things that took place during 2013 that you would need to know to be able to prepare the cash flow statement. Now, what they're going to do here is show you the indirect method. If you want to know more about the direct method, at the end of this chapter in Appendix 12B, that is explained. Now, let's look at the application of the indirect method. The net income is going to be computed using accrual accounting, which basically means you're going to put revenues in the period in which they were earned and expenses in the period in which they were incurred, what we've already been talking about through the first 11 chapters in this textbook. So keep in mind that those revenues and expenses do not necessarily equate with the actual amount of cash received or paid, because you may record the revenue, but you haven't actually got the money yet. Or you may record the expense, but you haven't actually had to pay or write the check yet, because we're doing this in terms of accrual accounting, not cash accounting. So the indirect method involves adjusting the net income figure to come up with the net cash provided or used by operating activities. So you have to subtract any non-cash increases and add any non-cash decreases back to the net income. So you start with net income, but then you have to adjust it for those things that didn't actually involve cash. So if we start with Genesis net income of $38,000 and we adjust it to come up with the net cash provided by operating activities of $20,000, Exhibit 1211 is going to show you the results of the indirect method of reporting operating cash flows. So you're going to have an adjustment that reflects changes in non-cash current assets and current liabilities, and also adjustments to the income statement items involving operating activities that did not affect cash inflow or outflow. And then you're going to eliminate any gains or losses that have to do with investing or financing activities, because we're only talking about operating activities here. So the first adjustment you have adjustments for changes in non-cash current assets. Changes in non-cash current assets normally result from operating activities. Examples are sales affecting accounts receivable and building usage affecting prepaid rent. So decreases in non-cash current assets are added to net income. And it explains the logic behind that. But an increase in a non-cash current asset, such as accounts receivable, implies less cash receipts than reflected in sales, so you have to adjust for that. So increases in non-cash current assets are subtracted from net income. Again, it's really best at first just to memorize this, and then the logic of it will make more sense the more often that you do it. So what they do down here is they show you, well, here's your income statement, the 38, it shows you your 38,000. Here's your balance sheet, it shows you the comparative 2012 to 2013. So then they're going to show you how that's going to affect the change in accounts receivable. How does it affect the statement of cash flows? So if you look up here, you see that there's an increase in accounts receivable between 2012 and 2013 of $20,000. So if you go back up here, increases in non-cash current assets are subtracted from net income. So your net income was $38,000. So in this case, this increase of $20,000 gets subtracted from this. Alright, so this increase implies that Genesis collects less cash than is reported in sales. That is, some of these sales were in the form of accounts receivable, and that amount has increased. So the people still owe you the money. They haven't paid you yet, so you don't actually have that $20,000 in cash. And then they explain that again here as to how that actually happens. So if you take each of these current assets up here and see the change, not counting cash obviously, this is an increase. So you're going to subtract it from net income. This is an increase. You're going to subtract it from net income. This is an increase. You're going to subtract it from net income. So if you look at your statement of cash flows, we start with net income, but then we're going to subtract the increase in accounts receivable, subtract the increase in merchandise inventory, and subtract the increase in prepaid expenses. And they go about doing that here. They explain it all, so I'll let you do that. Read that for yourselves. But then let's get to adjustments for changes in current liabilities. Changes in current liabilities also result generally from operating activities. So here, if you have an increase in the current liability, you're going to add it to net income. And if you have a decrease in the current liability, you're going to subtract it. So increases are added, decreases are subtracted, the opposite of what we did for the assets. So if we go back up here, look at the current liabilities, this is a decrease, so we're going to subtract. This is a decrease, we're going to subtract. This is an increase, so we're going to add it to our net income figure. So let's go back down here. Decrease in accounts payable, subtracted. Decrease in interest payable, subtracted. Increase in income tax payable, added. So remember, you're starting with net income, and then you're just looking at the change in these accounts, and then either subtracting or adding it based on whether or not it's an increase or a decrease. Okay, then we get to adjustments for operating items not providing or using cash. So again, there's usually some expenses that don't affect the cash for the period. So expenses with no cash outflows are added back to net income. Revenues with no cash inflows are subtracted from net income. Again, just follow the information. It'll make more sense the more statements that you do. But the biggest example of that is probably depreciation. Depreciation expense does not affect cash flow, so we add back the depreciation expense for the period. So let's go back up to our statement, and you see depreciation expense is being added back to the net income figure. And then the third area for operating activities. Adjustment for non-operating items. Net income often includes losses that are not part of operating activities but are also, but are part of either investing or financing activities. Examples are a loss from the sale of a plant asset and a loss from retirement of notes payable. So using the indirect method, we have to take non-operating losses and add them back to net income. Non-operating gains are subtracted from net income. So again, read this for yourself and try to understand the logic behind it. But non-operating losses are added back, non-operating gains are subtracted from net income. So they give you sort of a summary here of the things that we just talked about, which is going to make it, I think, easier to understand. This chart right here is the best thing for you to look at. For net, you start with net income. You add back any decreases in non-cash current assets. You subtract increases in the assets. You add increases in liabilities. You subtract decreases in liabilities. You add back depreciation, depletion, or amortization. You add back losses from disposal of long-term assets, and you subtract gains from disposal of long-term assets. And that will give you your net cash provided or used by operating activities. Remember, we haven't done the other two areas yet. This is just for the section on operating activities. Again, this is the indirect method. The direct method you will see in the appendix 12B, I believe it is. All right, so let's go back up to the actual statement. You start with the $38,000 net income, and then you do your increases or decreases based on the information that they gave you in terms of which way you do that. And then that will give you your net cash provided by operating activities. In this case, it's $20,000. Now, remember, our cash balance at year end was $17,000. So by the time we finish this, we should come out with this $17,000. And we've already shown how we do this. This doesn't change. So once you come out with the $20,000 here, your cash flow from investing activities ends up being $2,000. Net cash used in financing activities, $17,000 negative. So the net increase in cash was $5,000, as we already determined before. Add that to the cash balance at the end of last year, $12,000, so we get our new cash balance of $17,000. All right, let's move on to the next section. Cash flows from investing. All right, so the next step in coming up with our statement of cash flows is to look at our investing activities. So we want to look at the changes in our non-current asset accounts and the current accounts for notes receivable and investments in securities. By analyzing those changes, we can determine their impact on cash flow for this particular period. Now, in this case, it doesn't matter if you do it using the direct method or indirect method, you're going to come out with the same numbers at the end. So let's look at this, a three-stage process of analysis. Information to compute cash flows from investing activities usually comes from beginning and ending balance sheets in the income statement. We first have to identify changes in investing-related accounts, explain these changes using reconstruction analysis, and then report the cash flow impact. Now, this company purchased and sold plant assets during the period, and both of those are considered investing activities, so we have to look at how they're going to impact our cash flow. So we look at the comparative balance sheets and we look for any changes in these plant assets accounts. So what we see in this case is there's a $40,000 increase in plant assets from 210 to 250, but there's also a $12,000 increase in accumulated depreciation from 48,000 to 60,000. So how do we explain these changes? Now, back in the last few pages, they showed us some information that we needed to be able to do this, and items B and C are relevant in this particular situation. So we have to do reconstructed entries from prior transactions. Item B reported that Genesis purchased plant assets of $70,000, but the way that they did it is they issued $60,000 in notes payable and they paid $10,000 in cash. So the reconstructed entry for this item would be plant assets $70,000, notes payable $60,000 credit, and cash credit of $60,000. So you have a cash outflow of $10,000 for plant assets and a $60,000 non-cash investing and financing transaction. The next item says that they sold plant assets that cost $30,000, that had $12,000 of accumulated depreciation, but they only got $12,000 cash. That results in a $6,000 loss. So if you reconstructed the journal entry for that, you would say cash came in at $12,000, accumulated depreciation, we debit for $12,000, there's a loss on the sale of the asset for $6,000, so then we credit, because we're taking this plan asset off the books because we've just sold it, plan assets for $30,000. So in this case, there's a $12,000 cash inflow from the asset that was sold. The $6,000 loss doesn't actually have any impact on cash inflow or outflow. Now we also have to reconstruct the depreciation expense. You would debit depreciation expense for $24,000 and credit accumulated depreciation for $24,000. So this entry for depreciation expense also has no cash flow effect. So you then look at this and say, what impact did the entries we just reconstructed actually have on cash flow? Well, this is what we found. Cash received was $12,000, cash paid was $10,000. The rest of it is a non-cash investing and financing activity, so it doesn't have an impact on the statement of cash flows, but you can report it, or you should report it, in a note or a separate schedule so that people understand that yes, you had some other investing and financing activity, but it did not involve cash. So we purchased plan assets with issuance of notes, $60,000. Now, there are lots of other asset transactions that can be considered investing activities and can affect a company's cash flow. But this particular company, Genesis, did not enter into these things, so we don't have to look at the other accounts at this point. But if there were some other things like that, we would have to do the same type of analysis and reconstruct those entries and figure out how it impacted cash either coming in or going out. All right, so that's what we would have to do for Genesis for its investing activities. Now let's look at cash flows from financing activities. So of our 5 steps that we have to do, this is our 4th step. And in this case, we're looking at changes in non-current liability accounts and equity accounts. So the investing had to do with assets, the financing has to do with the liability and equity accounts. So this would be long-term debt, notes payable, bonds payable, common stock, retained earnings. Changes in these accounts have to be analyzed in terms of their impact on cash. Again, a 3-stage process. Identify the changes in those particular accounts, explain the changes using reconstruction analysis, and then report any of the things that had to do with cash flow. So we learned that there were 2 transactions involving non-current liabilities. We already talked about the issuance of $60,000 of notes payable to purchase plant assets. And we already talked about the fact that it's a non-cash investing or financing activity that we're going to disclose in a footnote. The other transaction has to do with the cash retirement of notes payable. So what we see here is in notes payable, there was an increase in notes payable from $64,000 to $90,000. So let's reconstruct what happens here. So item E of the additional information that we had reported that notes with a carrying value of $34,000 are retired for $18,000 cash, resulting in a $16,000 gain. So the reconstruction of item E would look like this. You would debit notes payable for $34,000. So you're getting the note payable off the books. And you received, or I'm sorry, you paid $18,000 cash to do that, which means you gained $16,000 because you ended up only having to pay $18,000 instead of $34,000. But this particular transaction involved an $18,000 cash outflow. Now, we also found that Genesis, as we said before, purchased plant assets costing $70,000 by issuing a $60,000 note payable, but they paid $10,000 in cash. We already reconstructed this entry when we were analyzing the investing activities. So you can see that the notes payable involves both of these transactions that we've just talked about and has everything in it that it's supposed to have. So the only thing that comes from this that we have to deal with in terms of cash, because we've already dealt with the transaction when we purchased the plant assets. So now we have to show that we had to pay out $18,000 to retire that note payable. So that would be our cash flow from financing activity, and in this case it's a cash outflow. Then we have to look at equity accounts. That was looking at the liability accounts. Now we have to look at equity to see if there's any cash flow issues. We had two transactions involving equity accounts. The first is that we issued common stock for cash. So we brought cash in by issuing common stock. And then the second is we declared and paid a cash dividend. So this is cash going out. So in this first entry, $15,000 came in for cash, and then the credit goes to common stock for $15,000. So that would be a $15,000 cash inflow. Sorry about my phone ringing in the background. And then as far as retained earnings, you have a cash dividend that was declared for $14,000 and then paid. So the debit goes to retained earnings for $14,000, but you have a credit for cash of $14,000. So you have a $14,000 cash outflow. So here you have cash inflow of $15,000, then you have cash outflow of $14,000. So the difference between the two is going to be $1,000. So the very last step is, once you've determined the net cash provided by operating activities, the net cash provided by investing activities, and the net cash used in financing activities, that gives you net increase in cash of $5,000. If you add that to last year's cash balance, are you going to come out with the balance that you currently have in your cash account at this year end? And this is where you have to prove it. It has to, if this number should match what your cash account says that you have at the end of the year. As I stated earlier, statement of cash flows can be confusing, and to begin with, if you just kind of follow the instructions in terms of what do you do with an increase in something, what do you do with a decrease in something, and just kind of plug stuff in, if you do 2 or 3 of these, it'll start to make sense as to how the reconciliation works and how you can be able to prove that the amount in your cash account is actually correct. but then also the statement shows you where that money's coming from. Investors use this to determine whether or not they want to invest in your company. And if they can see that you're making good use of your cash flow, and you also have enough cash on hand to take care of unexpected problems that might come up, then they're more likely to want to invest in your company. So let me know if you have any questions, but good luck with this last chapter that we're dealing with this time. Thank you.